for many different reasons. I kind of suspect that this year is not going to be any different, because I believe that financial and monetary conditions will remain extremely supportive of real asset pricing. Now, the irony really is that this year, as Michael has mentioned, we are looking at a slower growth environment. We are looking at a more heightened risk climate. And therefore, as a result, I do believe that central banks are more likely than not to try to hold monetary policy as accommodative and supportive of growth as possible. Now, this is not to say that everything is going to stay the same, because if there's any one point over the current 10-year cycle, I actually do believe that this is the year where we could actually be seeing a dislocation in the market. In other words, we may actually be seeing a greater divergence in terms of market performance. And therefore, it's highly important to be tactically smart and selective in our investments at this point of the cycle. Now, I've mentioned about a slower growth environment. Now, the US looks to be in a relatively good shape. The jobless rate is close to cyclical lows, and employment growth is robust. However, the outlook ahead is definitely less certain. The US dollar has appreciated. That's going to make US exports less competitive. The US housing market seems to be slowing as well. And then obviously we have a slower global growth, which will impact on global demand, US demand. And not to mention obviously that the appreciation of the US dollar is a key harbinger of slower growth. Now, I do believe that the Fed is going to pause this year after having raised rates by about 9 times since 2015 and 4 times in last year alone. And China is slowing. At the beginning of this year, we were expecting growth in China to hit about 6.2 to 6.3%. Now, today, the expectation is for growth to come in at around 6% or even sub 6% as a result of all the tensions that we're seeing with regards to the trade war and technology ban. Now, China has obviously a big impact on the global economy and global markets. China is a big manufacturing country, and China is a huge trading partner to many global economies, not least of all Europe. Now, even though the labor market has improved, as Michael has mentioned, the manufacturing sector seems to be in a contractionary mode at the moment. I hope you agree. And growth this year is likely to be a sub 1%. So no recession in Europe, but weak growth. So overall, we're looking at a sub-trend growth environment globally across many different markets. Now, even though the output gap has narrowed over the past few years, there is still significant excess capacity in many global economies. In other words, aggregate demand is still lagging behind aggregate supply. And as a result, we should be seeing ongoing disinflationary or weak inflation environment, which in turn, and particularly in Japan and the Eurozone, which means that central banks are more likely than not to want to keep monetary policy as supportive of growth as possible. Now, having said all these things, this year's growth is likely to be weaker, but the thing that worries me really is the risks that we're seeing globally. As Michael has mentioned, there is still the unresolved issue of Brexit. There is the trade war. There is the technology ban. And we have US elections coming up next year. And then we have also a US president who refuses simply to stop tweeting. It's like trying to stop a moth from flying towards the light bulb. It's almost impossible. So in view of the risks, investors who are looking to invest into the market should definitely be meaningfully cautious about their investments today. That's not to say that they do nothing. But as you can see, cap rates have compressed significantly over the past 10 years since the global financial crisis, with a corresponding increase in asset values. And therefore, if we're going to be investing into the market today, even compared to, let's say, 3 to 4 years ago, we should be expecting much thinner returns. And as a result of the elevated pricing cycle, it also makes a lot of sense to assume that one day the cycle is going to turn down, and therefore the yield impact on your returns are likely to be quite significant as well. So my advice to investors really is to focus on the core markets. Because as we have seen over the past many cycles, core investments hold up value much better during a downturn. And core investments obviously recover at a much faster pace. So buy into assets that have a long WALE, strong recurring income, potential for rental uplift, and then also that is going to be reflected in terms of the valuation going forward. Now this just gives you a snapshot of the markets that we think are interesting today. They do carry risks, to be honest, but there are some markets that definitely are a lot more attractive than others. So among the Australian cities, for instance, we like Brisbane, because Brisbane is on the throes of a rental supercycle, and the yield spread, the yield carries a premium to Sydney and Melbourne. And then we like Singapore office as well, because again, the rental cycle is on an upturn. And then Tokyo is interesting. There's going to be a lot of supply coming into the Tokyo market over the next 2 or 3 years. But if you look deep enough, there are actually sub-markets within Tokyo where the vacancy is very, very, very low. And future supply is going to be quite subdued. So even though we recommend to our investors that the fundamentals going forward, at least from a supply perspective, is not going to be so positive, but nevertheless, it's a market that we like a lot, as my next panelist will tell you. It's a very liquid market, and there are sub-markets that are actually very interesting because the vacancy rate is sub 2% in some of those. We give out recommendations to our clients. This slide shows you what we think are really important in this current cycle that I think investors should be aware of. I think the key really is this. We are looking at a very pricey environment, and therefore, sometimes we tend to underwrite in a way which is way too positive. So the key really is price to realize your target returns. In other words, put in assumptions that are meaningfully realistic and see if the returns work out based on the pricing. If you do that, you are actually being cautious in terms of your future investments. And then the other thing is avoid style drift. Do not move into markets just because the capital market is competitive. That doesn't need to invest into the market today because everybody is chasing yield, everybody's chasing assets still in this current market. And therefore, people tend to invest, some investors tend to look into markets that they have never actually bought into before. We wouldn't recommend that. And then the last thing really is rely on long-term value. And that's something that Nuveen adheres to very strictly. Because at the end of the day, there will always be cycles. That's the nature of the real estate market. So it's important also to be able to look past cycles. So be tactical, choose the right market at the right point of the cycle. But it's also important to be able to look past some of this short-term volatility and focus on the cities and sectors that are structurally positive over the long term. Because if you do that, you can be quite assured that even if there is a downturn, the peak of the next cycle is going to be higher than the previous peak. I kind of sense that I'm running out of time. Is that right? Let me just show you a slide that at Nuveen Real Estate, our investment philosophy is always being underpinned by our city's strategy. In other words, selecting the most resilient cities over the long term that can create attractive risk-adjusted returns for your portfolio. And we have selected 17 cities that we recommend our investors to invest into based on structural megatrends. Whether it's urbanization, whether it's the rise of the middle class, which obviously will increase the demand for real estate over time, and that shapes our core strategies. And then there is aging population, technology shift, and so on, which changes the demand for real estate, and that shapes our strategies for emerging markets. But of the 17 cities that were selected, that we recommend to our clients, 6 are in Australia. There are 3 principal cities, in other words, 3 main core Australian cities, which is Sydney, Melbourne, and Brisbane, that we advise our clients to invest into today. And then similarly in Japan, we advise our clients to invest into Tokyo, Osaka, and Nagoya as attractive long-term cities to hold an asset into within your portfolio. And in China, we advise clients to invest into Beijing and Shanghai, and then keep an eye on markets such as Shenzhen and Guangzhou. All right, I guess let me stop here. Sorry about that.